We had 18 grams over 9 meters. In the same hole, we had 100 meters of 0.5 separate intersections in the same hole. This was a surprise to us. We've never seen those grades before.
The Financial Survival Network. Now more than ever. The Financial Survival Network.
And welcome. You are listening to, watching the Financial Survival Network. I'm Kerry Lutz. Well, we're always on the lookout for value, always on the lookout for new opportunities. You know, so much of life is about transformation, rebirth, and this is especially true in the mining industry. But, you know, it takes vision and it takes guts to go back to abandoned projects with new eyes and to see the possibilities and then to actually go for it. QC Copper and Gold CEO Stewart, you are doing exactly that. You've taken the legendary Opemiska Mining Complex that produced over 23 million tons of copper in its heyday and a lot of gold. You're breathing new life into it. And best of all, sometime shortly, within the next month, we're going to see a maiden 43-101 resource estimate. And to top it all off, recently just intersected 9 meters of 18.3 grams per ton gold, 0.5% copper. Stephen, it's great to have you back on. It's hard to go back to an old mine that has been abandoned because it's uneconomical and find value in it. And yet that's the model that you're using.
Oh, well, look, Kerry, it's great to be here. And you're exactly right. We are reinventing a legendary mine called the Opemiska into a new large open pit deposit. Very high grade copper with a nice gold credit. And we're doing it all in the middle of Quebec, right next to infrastructure. There's a railroad right beside us. There's airport road, paved road, power to site. This project checks all the boxes. Right now, I think it's an excellent opportunity for value to take a look at QC Copper. We're going to be defining how big this open pit resource is in the coming weeks, as you indicated. It's a very exciting time for us. We're so excited to be able to communicate exactly what this project is in terms of tons and grade, be able to talk about that and show value, because I think I can't wait to deliver a great report for our shareholders who have been patient with us as we've drilled out this 20,000 meters, which is going to be leveraging upon 800,000 meters drilled by Falcon Bridge. So this is going to be a very data-rich report. We think it's going to be sizable. We think it has the potential to be the biggest copper gold open pit deposit in Eastern Canada. So it's and when you look at our market cap, I think it's a great opportunity to have a look at it. So I'm very pleased to be here to speak to your listeners and break down the details.
Yeah, so your market cap right now stands 20 plus million.
About 20 million Canadian. But if you look at what you're really getting in terms of the enterprise value, so we start off with a 20 million, we've got about $3 or $4 million in cash. We have about $10 million in equitable securities and shares of a company called Baseload, which is a larger uranium company that we spun off and we own 36% of. So if you do the math, investors are getting $6 million for our copper assets, which includes our flagship, the Opemiska, which we've been talking about, but also we own 50% of a 500,000 ounce resource, which is a stone's throw away, literally 10 kilometers from Opemiska, which is an open pit deposit as well. So in terms of value propositions, I don't see anything better in the market these days than what QC Copper has in terms of its relative value.
Its relative value, plus to bring this mine into production, we're talking a pretty low Capex here as well.
Well, we haven't defined the Capex yet. That's going to come after our maiden resource. But yes, intuitively, it is going to be much lower. There's going to be no billion-dollar line item that you see in some of these far-off remote projects. We are in the heart of Quebec. All we have to do is dig a hole, which is always something you got to do. Not to belittle the complexity or expense, but it's going to be a big open pit. Build a mill. There's no as I said, $1 billion line item in terms of building a rail, which you have to do for these for these bulk tonnage projects. So it has so many advantages, so much so that we think this can be developed this cycle, which is key. I mean, there's a lot of great projects out there coming out with other drill results in all sorts of foreign countries that are very sexy. However, they're very likely going to be developed next cycle. We think this has the chance to be done this cycle when copper is really looking fantastic at nearly, it's back up this morning, almost $4.40 per pound. And gold is behaving very well as well. And we have, not to mention, you alluded to that drill intersection. We had 18 grams over 9 meters in the same hole. We had 100 meters of 0.5 separate intersections in the same hole. This was a surprise to us. We didn't expect to hit such high grade gold very close to surface. It was about 300 meters downhole. So we think that's going to go into an open pit. And as I said, we did not expect that. We knew there was gold in the system. We didn't expect it to be that high grade. We weren't expecting to hit that zone. So that's certainly something we're going to follow up very shortly as well. So it's a great opportunity to get exposure to copper and its exposure to the electrification revolution, as I say, but also gold, which is tried and true and very relevant in this day and age of printing money until infinity. So it has both aspects of two of the most exciting commodities in this business. And then again, we throw in the uranium. We got a uranium kicker, so we got exposure to a bunch of commodities. But I don't want to get too wide. Really, the focus is all about this Opemiska open pit, defining its size, ultimately its economics, and then driving this forward and developing it in this cycle. That's our objective.
Had Falconbridge ever hit that grade of gold before? My understanding was it was much lower grade.
We've never seen those grades before. So I can't say what they may have or may not have hit, but no, we've never seen it in the data, not grades like that, not widths like that. 9 meters to have nearly that's well over half, 2/3 of an ounce over 9 meters, which is, that's ore grade over ore width, if I've ever heard it, right in the middle of Quebec. So, maybe this turns out to be a gold mine. I mean, it's a copper mine with a gold mine kicker, but it's early days on that intersection, but it was a very pleasant surprise, no question.
Now, one thing you mentioned was the halo effect. You like the veins. The veins are high grade, highly productive potentially, but you said it's what's outside the veins that really caught your attention.
Well, certainly. So this, for those who don't know, the Opemiska Copper Mine Complex was 4 individual mines, all very tightly spaced, but they were 4 high-grade underground mines operated by Falconbridge, which of course is now Glencore, one of the third largest mining company in the world. And so this was mined for 50 years underground at a very, very high grade copper veins. They were mining up to 10% copper over very wide widths. It was a very profitable mine. And when it shut down in the early to mid 90s, copper was at a different space. And I don't think they really truly understood what existed outside of these high-grade veins. We know that because when we were looking at their data, they did not assay. They didn't test outside of these high-grade veins. They just sort of treated it as waste. But in the context of plus $4 copper, and more importantly, in the context of an open pit, because your economics and your engineering strategy is completely different than it is underground, where you're trying to be a surgeon in terms of what rock you move. But when you're moving bulk tonnage in an open pit, if you can get paid for that rock, then that becomes a game changer. This is a model that was, I don't say pioneered, but certainly the best known case is Osisko in the Malartic mine, where they did something quite similar to us, but this happened 15 years ago. They acquired a mine, the Malartic, out of bankruptcy for $80,000, and they spent the next 6-7 years drilling this thing until oblivion, really, and ultimately defining a very large one gram open pit deposit in the middle of Quebec that nobody knew was there. And then they ended up selling it for $4 billion. And now it's Canada's largest gold mine. So this reinterpreting high-grade underground mines from yesteryear into open pit deposits, brownfields environments is really a model that we love. We went after this specifically for that. This was a model that we participated in the past. Our group did the Cote Lake project. We were part of the discovery group of that when that was, a high-grade underground gold mine, drilled 100 meters at a gram. It was sold to IM Gold for nearly $700 million in the last cycle. So this is not a strategy that we're naive to. This is, I think, the approach that is going to be very successful in the years coming ahead, because let's face it, these gold and copper mines are very, very hard to find. All the, call it, low-hanging fruit, those that are at surface and obvious, have been found because we've been scouring the earth for 100 years. We're very good at what we do when I say the industry. So we have to look at new strategies for finding these deposits, or you got to go much deeper, which is much more expensive. That's not what we're doing. We're just reinterpreting something that is, we think, is low-hanging fruit, which is not going to be around for too much longer. But this is an incredible opportunity for our shareholders and for us who acquired this very, very cheaply in a down cycle, which is, we play the cycles. We acquired this back in 2018 when nobody cared about copper. That narrative has certainly changed as the economy is picking up, infrastructure is being built, and to layer on top of that is the electrification aspect. And if we are going to transplant ourselves away from fossil fuels, whatever your opinion is on climate change, is being mandated, and we have to get out of from this tremendous amount of carbon that is being burned. And if you're going to do that, you're going to need uranium to produce the energy. You're going to need copper to transport it from these power plants to wherever, and obviously internally within your cars and your homes. And then you're going to need nickel to store it in these mobile batteries. So those are really the commodities that we're interested in, and we think copper is at the crux of all of that. You just simply cannot replace copper pragmatically in that equation.
And then one thing I like about this project, Stephen, is it's really de-risked here. You can't picture it trading your shares trading any less than they are. I mean, really, I think I'm quoting somebody that said this, it probably was you, is you're literally getting this project for pennies on the dollar. And that's kind of your overarching value in any project that you invest in, is that the downside's covered and the upside can be so great because you're paying so little for what really is almost a proven asset.
Well, I guess they call that, asymmetry. And so I think the downside, while there's always downside in any exploration business, we think the downside is very much covered given our price. Relative to the upside and where we can go. If you look at some of the comparables of assets that have 50 million tons, 75 million tons, 100 million tons, the direction that we're going in, and if you layer on, call it a 1% copper equivalent in there. I mean, the market caps start in $100 million and go up to $500 million. Considering we're $20 million with all those other extraneous cash items baked into it, there's huge upside. So I see tremendous asymmetry in the investment into QC Copper right now relative to the upside to the downside. So, look, I'm biased. I'm the CEO. I'm one of the largest, if not the largest individual shareholder in this company, but I'm a believer in it. And, I'm going to continue to buy shares once this resource comes out and support this all the way through until we develop it ourselves or sell it to a big guy, because I really do believe that's, the latter is probably the most probable, because the big guys are better at building mines and operating mines certainly than we are. But there's M&A on the horizons, particularly with gold, particularly with copper, and particularly with assets in the middle of Quebec and in Canada. No better place to be, as far as I'm concerned, jurisdictionally wise. Totally supportive government, totally supportive First Nations, provided everybody's treated as a partner, which they absolutely are. To get social license there is obviously a lot of work, but certainly possible. It's been proven time and time again that Quebec is there. And we've got a very good supportive shareholder base. And so there's a lot of value, a lot of upside, and a lot of different ways that investor can gain exposure to, as I said, copper, gold, and uranium within QC Copper.
You said before, 1% copper plus 1 gram per ton gold really can provide amazing returns. But now with what we're seeing here, it could go way, way beyond that.
Well, I won't comment on where we think the grades are going to be. We certainly, 1% is certainly a target of ours. We think that's realistic. It all depends on where the tons come in. You can sort of increase your tons and lower your grade. You can increase your grade, lower your tons. So that's sort of a a give and a take parameter, where we think it's going to be very healthy on both sides, both the grade and both the tons. That's how projects are initially gauged, and then you're going to layer on the economics. And we think the economics, which will come in the form of a PEA, are going to be very favorable. We're certainly in the resource. We're going to be pit constrained, so that means any resource we're quoting is conceptually in a pit that can be mined, and then we'll define the economics of how much it costs us to mine this relative to what a ton of rock is going to be. And I'll point out, go to our presentation. You'll see a lot of your listeners will understand what 1 gram means in a ton of rock. It's anywhere from $60 to $70, depends on where the price of gold is, but that's in with range bound where it is now. But 1% copper, not a lot of people understand that, what it is in a ton of rock, and it's really at today's prices 30 to 40% higher than 1 gram per ton. So you're getting nearly $100 per ton in that ton of rock that you move. So a 1% copper deposit has extremely valuable rock. And so it gives you a real high margin project if we can bring it in that parameter.
Yeah, I'm still shaking my head, honestly, Stephen, how undervalued this appears to be, and that the market just kind of overlooked it. But the 43,101 could really be the turning point for the company's valuation.
Well, I think it is an opportunity because when we did this financing, or our last financing we did in November, we shot up to 35 cents, and the market's cooled off. I mean, there's no disputing that. It's the summer doldrums, but gold has cooled off, and so have the juniors. And so, I mean, to me, that's the opportunity. I think I would say that the juniors is at or near a low. There's a lot of companies trading at their 52-week lows, and I always kick myself when I don't jump into the market when I see that later term, provided you can be patient, right? I mean, the market can always go lower, but if you're patient and you pick the right projects with the right teams behind it, and you look for value, I think this industry offers so many great investments, again, provided you do your proper due diligence, because it's companies like QC Copper and some of our contemporaries that can go 10 baggers, even more when the conditions are right.
Okay. And you got to be encouraged by the price of copper, hit an all-time high, pulled back down to the low fours, and now it's just staying right over $4. It almost went down a little bit, a couple times below $4, but now it's well over, like you said, $4.40 a pound. So that's got to give it all a lot of support as well.
Copper's been very strong. It's performed fantastic since the lows of when it was below $2. It's rallied there because people expect infrastructure building to come out of all this precipitous money. And so hopefully they put it to good use to build roads, tunnels, and all sorts of next generational electrical things, as opposed to just throwing it away, which unfortunately some of it's going to happen. But there's no question that infrastructure is going to be built as we get out of this sort of situation, and a good chunk of that copper is going to be responsible for. And again, the electrification aspect has a big boost on the narrative. So copper is, if you believe some of the experts, they say, I think it was Goldman says copper is going to be $5 by the end of this year. Not that I believe what they're telling me, but nonetheless, we think that the macro view on copper is extremely good. We invested in copper specifically because we like the long-term supply-demand fundamentals. If you look at the supply, it's being largely supplied from Chile. It's the world's largest copper producer. But these mines in production down there, Chuquicamata, Escondida, beautiful mines, been around for 70 years, but that means they're old, they're tired. Their grades have come down from plus 1% down to 0.5% copper, which they're mining. So their costs have gone way up. They have economic challenges as we go into the next decade, and so on and so forth. So, and then in order to replace those reserves is very, very difficult. The best deposit out there, in my mind, is out in the DRC with Mr. Friedland. Fantastic grades, starting to produce, but very risky jurisdiction. So, I wish them the best, but there's no better place to be than Quebec in a high grade, near surface deposit like we have at QC Copper.
Yeah, and the timing aspect, like you said, that you're going to actually be able to take advantage of the current cycle. It's going to get realized, hopefully, in this cycle, as opposed to these other projects that take 10 years. They look great. They're in questionable jurisdictions. There's no infrastructure. all these things, it seems like you've got all those things going for you here.
Well, certainly, we think we're well positioned to develop this in this cycle. Hopefully, the cycle has legs. We think it does. Call it the next 5 to 10 years. That's the cycle I think we're in for a real bull metals market, base metals and precious metals as well. If you have a $1 to $5 billion capex, you've got big challenges. Some of these mines can be in production for 100 years, but it takes an awful lot of capital to develop them, and then you got to manage that throughout a cycle. We think that this project, it's not going to be a $5 billion capex, nowhere near that. So the financing aspect of it is much more palatable to the market, and the logistical challenges are much less significant, given that we don't have to deal with most of them. So it's a unique project. I think the time is right. We're well positioned. We're in a good jurisdiction, and we've got this catalyst coming out in a matter of less than weeks.
Well, we like it. Probably be getting more shares. It sounds like a great buy. It sounds like a great buy in so many different areas: a value play, a resource play, a renewal play, if you will. So I think you should go over, take a look at qccopper.com, sign up for notifications so you'll get notified immediately when that 43101 comes out, which is going to be shortly. The ticker symbols in the US, it's QCCUF. And of course, in Canada, it's QCCU. Stephen, wish you the best, and we'll be checking up with you shortly. Thanks so much for coming on.
Fantastic, Kerry. Appreciate it. And I'll look forward to coming out when this resource is out and updating all your listeners.
The Financial Survival Network.